I do it because you dream it. The heartbeat of possible, giving wings to restless quest. I'm the gateway to adventure. The footfall of journeys near and far. Places and spaces. And faces discovered and brought to life. I am the smile that welcomes, the embrace that says it all. Many facets of many things. Seamless and unseen, making ordinary extraordinary. I am the key to opportunity. The place where minds open and dreams fulfill. Taking off with boundless purpose. Touching down with heartfelt pride. Rooted in Africa. And dancing across the world. Every day, in every way, I champion passion and results and integrity and diversity and excellence. Living the values of heartfelt pride. I am the spark in your imagination, the flame in your heart, fearless and limitless, always striving, always thriving, always connecting you to possibilities.
Good morning, ladies and gentlemen. Welcome to the Airports Company South Africa's annual financial results. I am Refense Shinas, the Group Executive for Corporate Affairs, and I will be facilitating today's presentation. In studio this morning, we have our CEO, Ms. Mpumi Mpofu. Welcome, CEO. And our Chief Financial Officer, Mr. Spamandla Mthethwa. Welcome, Nyembose. Thank you to everyone joining us from across the country, watching via our webinar platform. Today's presentation is live and interactive. For those of you who may have questions, please note that we will take those at the end of the presentations. You can either send through your questions by posting in the Q&A box on your screen, or you can email nonkanyiso.nyilika@airports.co.za during the presentation. Lastly, you can call us live in the studio once the lines are open. These details will be on your screens shortly. We will cover as many questions as possible in the time available. For those of you that may need to prepare a report this afternoon still, you can also use the same email address for follow-up questions. We also have media interviews scheduled for this afternoon going into the evening. So we will take media questions at that time or by email. CEO, let me hand over to you so that you can take us through the introductory part of the presentation.
Thank you very much, Refense. Good morning, ladies and gentlemen. Today, our presentation will cover the impact of COVID, the economic and aviation sector outlook, transformation in our operating environment. The CFO will then deal with the financial performance. I will return to discuss the revised strategy and forward-looking approaches, and then we'll go into the questions and answer session. The first part of the presentation, we remind all of us of the devastating impact of COVID towards the tail end of the year under review. Importantly, though, AXA was a company that was well positioned to weather the storm. We successfully enacted a business continuity plans, served our stakeholders, and protected our people. Our mandate affirms our role as a leading global airport operator, and our network was on track to record 3.3% in total passenger growth in February 2020. However, with the travel bans and hard lockdown, this led to a contraction for the year of 0.9%. We approached the economic regulator for a postponement of the submission of the permission application for 1 year, which was granted. Our on-time performance, on average, was 85.05% compared to the 84.09% of the previous year. And 3 of our largest airports went on to receive the OAG awards. Our air service quality performance on the network of our airports achieved the score of 4.04 compared to 3.97 in the previous year. The Civil Aviation Industry Awards, OR Tambo International Airport, King Shaka International was a runner-up, when OR Tambo was the winner in the Aviation Sustainability and Environment category. We continue to develop routes in our 3 international airports, and we continued also to develop collaborative partnerships, which include the Air Access in Gauteng and Cape Town, Durban Direct, and Nelson Mandela Bay airlift programs. COVID has had a devastating impact. Here we provide you with data which indicates the global cases on the left of more than 40 million, and importantly, on the right-hand side, 1.125 million unfortunate deaths that have happened across the globe. We provide more information, providing countries that are leading, including South Africa at the bottom. But more importantly here, we also highlight the last 24 hours, both in cases reported, which is the second column, and the last column, which gives you deaths reported in the last 24 hours, dated 21st of October, courtesy of World Health Organization. We also show you the impact of COVID across the various regions of the world, with the Americas leading, and importantly, the African continent coming in second lowest across the globe. On Africa, importantly, South Africa continues to lead in terms of the impact, devastating impact of COVID, with North Africa coming in second, West Africa, and importantly, East Africa, with Ethiopia leading the East African countries. There we provide you with even more detailed information. And again, very useful is the data that analyzes cases over 24 hours because it predicts the trends and the increase on the African continent. In South Africa, the 4th column highlights 21 deaths recorded in the last 24 hours before the 21st of October. And that is a cause for concern because we're starting to see the death numbers again starting to rise. Here we provide you with COVID statistics across the country, 4.5 million tested cases, and positive cases out of that who have been tested, 706,000. Importantly though, 18,656 of total deaths. We've also provided you with data per province with confirmed cases, deaths, and recoveries in each province. Out of all of this, the recovery rate seems to be quite surprising. In South Africa, currently our recovery rate is above 90%, which is really comforting, and it continues to increase. Importantly, we've also provided you with data across the provinces indicating Gauteng on the second column with 32%, KwaZulu-Natal 17%, Western Cape 16.2%, and Eastern Cape at 13.1%. In the economic outlook, we provide data here that shows our annual GDP forecast for the country, which shows a major contraction in 2020 of minus 8.2%. And on the right-hand side, we provide GDP levels of other countries, including Venezuela, Lebanon, the United States of America, which just shows you comparatively where we are as South Africa, as indicated in those GDP levels. Growth projections are indicated here with the global economy in 2020 likely to see a minus 4.4%. Importantly, we've also provided data for advanced economies and emerging and developing economies at minus 5.8% and minus 3.3% respectively. And the bottom of that slide, we look very specifically at the regions of the world comparatively and compare that to the world totals. I'd like to draw your attention to the sub-Saharan Africa on the southeastern quadrant, which show a minus 3% contraction in terms of global growth. In this particular slide, we focus back on South Africa and look at the various economic sectors. And as you can see, very importantly, when you break down the expected contraction of minus 8.2%, we see the various trends that are predicted for mining, manufacturing, tourism, retail and sales, domestic vehicles and goods exports. Importantly, most of the sectors have seen a very strong rebound after April and the reopening of the economy, with the exception of tourism. And the real impact of tourism is basically largely related to the continuing cross-border travel restrictions. Importantly also, whilst we show you a graph on the labor market indicated on the right-hand side, we can see that what is likely to face us is a decrease in disposable income as a result of job losses, which undermines the potential for air travel at demand recovery. But importantly also, passenger growth will remain muted into the future because of the deglobalization trends that are emerging. With respect to global economy, we've seen large-scale quarantines, travel restrictions, and protocols in place. Consumers and businesses spending is expected to fall sharply, but importantly, the economic impact is likely to lead to a very severe global recession. In the South African context, we expected to experience severe pressure, and the economic performance has been adversely affected by an already weak economic performance even prior to COVID, which constituted weak domestic demand, electricity supply uncertainty, and policy uncertainty, and importantly, now increasingly a challenging global trading environment. In the air transport sector, we have been severely impacted by the coronavirus pandemic, with airlines unable to survive. The South African Airlines and Business Rescue, we know two of them, and this has created even more uncertainty in the domestic market. And then the high cost of doing business is expected, with low growth in passenger demand, and importantly, the air transport sector fueling further unpredictability and uncertainty. We also see that the recovery in the air transport sector is expected to be slower than the rest of the economy because of continued travel restrictions, as I indicated. In the aviation sector, we give you some further data which helps you to see the ICAO forecast evolution shows predictably that we will see a decline in world passenger traffic. Initially, the figures, the first chart shows us a decline in terms of the forecast at August 2020, which was up to minus 60%. ICAO significantly reviewed that in the previous month on the 12th of August to minus 59%. But in September, they revised that down to minus 61%. And the latest at October the 8th is indicative of a minus 62% decline in passenger traffic. This particular picture is not giving us confidence. Importantly, as travel restrictions continue, importantly, those forecasts, however, are showing a narrowing range, which is an indicator of improving stability in the air travel market, albeit still in unfavorable conditions. In this particular slide, we show you the difference between domestic and international impacts across the various globes. And for your attention, we'd like to draw attention to the continent of Africa and the impact it's had in our continent. We then deal with projected airport losses. And in this particular slide, again, in Africa, we show airport revenues at minus 59.8%. And in this particular instance, we see that the passenger volumes in Africa is envisaged to be of a wider magnitude than the global result, the global average, which will result in revenue losses performing better than the average revenue losses. The African revenue split historically, this is where we were, and we've split this particular information in terms of the aeronautical revenue and non-aeronautical revenue and non-operating revenue. Importantly, again, is to note the last column that shows the African continent on the right-hand side. Global Traffic Recovery Index has shown us, importantly, how long it's going to take the air transport sector to come back to normal. In the first graph above, we show a certain period of uncertainty, importantly between 2020 to about 2028, which even though shows a very important increase around about 2024 of approximating projections back in 2019 of where we expected to be. So overall, we would see us only returning to the 2019 projections possibly in about 4 to 5 years, was indicated in the graph above. What is important to note is that global traffic, passenger traffic is not anticipated to return to 2019 levels before 2023, but importantly, it's pointing to a potential structural break in air traffic. The one below, which basically indicates the same trend, is also highlighting a new baseline forecast, which is slightly improved from the previous one, but importantly, shows a range of uncertainty larger in that particular space, closer to 2024. Importantly, AXA's long-term forecasts are also pointing towards this particular structural change. IATA does surveys that are very useful to judge what happens in the demand side. What is indicated here is a usual survey they conduct in April, June, and September, which shows the willingness of passengers to fly. In this particular indication, only 50% in 2020 are indicating a willingness to fly within 6 months, and that is actually quite concerning. And that particular indicator is used as a predictive model for passenger demand for air transport. The high-risk country announcement, which was made by the president on the 19th of October, indicates those countries which remain on that list. And importantly, we know that this is updated every 2 weeks. Finally, this particular year has been a difficult year for us, but only really towards the tail end, which started seeing the devastating impacts of COVID. Our performance report indicates that on return on equity, we had a target of 3.4%, and we actually achieved and exceeded it and achieved 5.4%. On return on capital employed, our target of 4.6% was also exceeded, and we achieved 6.2%. On the non-aeronautical revenue, we just missed the target of 3.253 billion. And on the reputation index, we also performed slightly lower than the expected 65% at 64.1%. Our ASQ index, as I indicated earlier, for the year was at 4.08%, which was higher than we had targeted for ourselves. And the BEE level 2 was affirmed and for the year. And we also measure the performance of Black business share of commercial revenue generated, where we exceeded this at 55.4% compared to the 55% we had set. Number of job opportunities created, we achieved 23,750 as opposed to the 25,666 we had targeted ourselves. And then finally, on the ACI carbon accreditation level, we attained level 2 reduction certificate for OR Tambo International Airport, Cape Town International Airport, King Shaka, which was a new entrant in that year, and also the last airport where we achieved more than we expected in the ACI carbon accreditation. That brings me to the end of this part of the presentation. I will hand over to the CFO and we'll come back to you to discuss the company strategy later on. Thank you.
Thank you for that presentation, CEO. Ladies and gentlemen, the CEO has shared the current impact of COVID-19. She will be back later, as indicated, to share what the future has in store for AXA. The CFO will now be talking us through the numbers, the financial results for the previous financial year. Please remember that you can send through your questions and we will address these after all the presentations. CFO, over to you.
Thank you very much, Refense. Good morning, everyone. Just before I start the presentation, before I go into the slide, I just want to create the context in terms of the numbers that you are seeing today. These numbers are affected by two major issues. First of all, even before we went into COVID, the economy was already under pressure. We had electricity supply constraints and the economy was growing at less than 2%. And those conditions prevailed for at least the first 3 quarters of the financial year. And in the last quarter, the second issue, which is quite obvious and the CEO has gone into detail on, is the issue of COVID, which started to hit us in the last quarter with the countries going into lockdown and travel just generally decreasing in this quarter. So these two issues did affect our numbers that you're going to see today. The presentation is going to cover a couple of issues. I'm going to talk to the highlights first. I'm going to take you through our income statement, or statement of comprehensive income, go to the financial position, look at the cash flow, and also some analysis on our debt evolution. And in conclusion, I'm just going to conclude with, that's the summary of what I'll be talking about today. Just to start, in terms of the highlights, if you look at our revenue did decrease by less than 1% for the year. The primary drivers for that, our revenue is split 53% aeronautical and 47% non-aeronautical. On the aeronautical revenue, which is the passenger service charges, landing fees, and parking, the reason that revenue category decreased by 1.7% due to two reasons: that we didn't have a tariff increase for the year, and secondly, with COVID in the last quarter, we started to see the air traffic movements decreasing, and also the passenger volumes also decrease. On the non-aeronautical side, there was a positive growth about 1.9%, especially on rental and retail. But you can understand also the non-aeronautical revenue was also affected by the last quarter slow trading environment. So overall, our revenue was almost flat for the year. EBITDA did decrease from 2.9 to 2.6 billion. Primarily, obviously, even though you can see that the revenue was flat, but we experienced cost pressures, especially on the employee cost, annual salary increase, headcount increase to drive what we had as a growth strategy before. And also, we also saw the full impact of the staff transport, which was introduced in the prior year. Also with COVID at year end, we also had to make a provision for doubtful debts due to the pressures that airlines and also the concessionaires and retailers were facing at that time. So our overall provision did increase by about 270 million rand. The profit for the year, which you see on the right-hand side, increased from 200 million to 1.2 billion. That is driven primarily by reevaluation of fair value adjustment on our investment properties using the income capitalization method. We realized a gain of 721 million. And the main reason for the increase is we signed new contracts, and also there were some renewals that lifted the value from 7 billion to 7.7 billion. So the value in the balance sheet of the investment property is about 7.7 billion. The ROE and ROC obviously did improve because of the profit that you've just seen. We spent 1.3 billion rand on capital for the year. About half of that went into our investment property. We also spent about 20% on refurbishments on the taxiways and also some apron stands, and we also invested on IT systems and infrastructure as well. So that was our capex for the year. On the balance sheet, we have assets of 32 billion, which we closed the year with. Very good assets. 7.7 billion of that is our investment properties. And we also have a world-class infrastructure in our airports, primarily the Golden Triangle, which is King Shaka, OR Tambo, and Cape Town, making up a significant portion of that. From a gearing perspective, our gearing went down by 1%. We were on a deliberate strategy to reduce debt, and it's a very, very positive position we started, especially going into COVID, with a very low levels of gearing. And finally, on the highlights, we've got just an improvement on concession investments, primarily due to the exchange rate, basically weakening of the rand against the Indian rupee. This is on our Indian investment in MEAR. So that's what drove the value there, just the currency, not much about the profit of the investment. So that is the financial summary. In concluding this slide, I think what is clear is that despite the pressures, as I've highlighted earlier, weak economy, COVID, the company did close the financial year in a very strong position, and we went into COVID with a much stronger position. If you go to our income statement, I have already highlighted some of this. You can clearly see there the impairment of receivables, an example, did increase quite substantially. As we went into end of the financial year, some of the airlines were already on business rescue, and we had to increase our impairment there. Overall, our impairment balance in the balance sheet is about just under 500 million. That was just the movement for the year. I've spoken about employee cost, the salary increases, and also full year of staff transport, and some headcount reduction, which was driven by the growth strategy at the time. The fair value gains, as you can see. What I can also just highlight there, you can also see that our finance charges went down, primarily due to obviously the lower interest rate environment and the fact that our debt is also decreasing. And overall, we can see a profit of almost 1.2 billion. The tax for the year obviously was lower. If you look at the tax number, versus a high profit, you must just understand that in the profit that we're including the fair value gains, which don't attract tax almost immediately. So that's the income, the comprehensive income overview. Now I'm just going to go through a bit more detail on the breakdown on some of the numbers. This is our revenue, which, as I've said earlier, is about 53%. That is aeronautical revenue. You can see that there was a decline, as I've indicated earlier, no increase in tariffs, and also just the low traffic volumes that we saw at the airports. On the non-aeronautical side, there was overall 1.9% increase, primarily on the retail and also on the rental. With COVID, you can clearly see that in the last quarter, you started seeing the impact. Parking and car hire was down for the financial year. If you go to the expenses, as I've highlighted earlier, big increase, 11% on employee costs. I've already highlighted what the drive. Utilities went down. We've been on a drive to optimize the utilities. We renegotiated tariffs with the three major metros in which our airports are, and we are seeing the positive impact of that. Security cost continues to increase by about 12% as we continue to enforce compliance measures across our airports. Repairs and maintenance very much in line with inflation, and the rest is something that is under control. So that is the breakdown of expenses. If we go into the balance sheet, I must say that we went into COVID with a much stronger balance sheet. If you look at our net asset value of 22 billion, which includes obviously our investment properties, our world-class infrastructure in terms of our airports. It is a position that is obviously that we went into COVID, and it did assist us in managing the difficulties of COVID, especially for the first 6 months of the new financial year. If you go to the cash flow statement, what is positive from a cash flow statement is that what you can clearly see there is that we generated net cash from operations of 2.5 billion, which was sufficient for us to fund our capital and also for servicing of our debt. So for the year, we didn't need any external funding, which is just an indication that the finances of the company were well managed, generate enough cash to fund not only operating expenses, fund capital, and also to be able to repay debt. So that's on the cash flow statements. And just on the debt evolution, we've been on a debt early redemption strategy, and our gearing has gone down from 63% in 2010 when we had the World Cup to 17% now, which is very, very positive. The business has been generating good cash flows, enabling us to reduce debt quite significantly. And we don't anticipate, even in the post-COVID environment, that our debt, our gearing will actually go back to the levels of 63%. In fact, on our worst case scenarios, we are anticipating about 53% at the peak in the gearing ratio. If you look at the debt itself, it has come down from 17 billion to about 6 billion, just to give you a sense in terms of the numbers. In conclusion, obviously we had COVID, it had impact. You already see it in the last quarter in the numbers. The impact of COVID for us, obviously, in this financial year, and at least in the medium term, is that we are forecasting operating losses. Our credit metrics will deteriorate and in breach of covenants. And also we have a liquidity issue, which we are actively managing at the moment. From an intervention perspective, as we could clearly see that there is a clear possibility that we will be in breach of covenants. So we have negotiated with our major lender, which is AFD, and they've waived the covenants until June 2022. We went out in the market for credit facilities. We've secured 3 billion rand in credit facilities, and we are still pursuing additional credit facilities. From interventions on the financial plan, from a long-term sustainability, we have cut our expenses by 25%, and we are limiting the capital expenditure to about 1 billion. Prior to COVID, we had a CapEx plan of about 17 billion, and we are now over a 3-year period, and that is now down to about 2.8 billion over the next 3 years. We are also looking at diversifying our sources for funding, and also just spreading the maturity profile of that funding. And also, as you saw earlier, we have a good investment property portfolio which appreciated in this financial year, and we are looking at monetizing at least half of that portfolio just to improve our liquidity going forward. And lastly, we are also looking at engaging, as the CEO said earlier, that we've got a postponement for the permission application to June next year, and we've developed a very clear roadmap and a strategy on regulatory strategy to ensure that the outcomes thereof are positive, and also assist us in managing the liquidity issues and just overall the financial sustainability of the company overall. I think that's it. But thank you very much, Referencer.
CFO, thank you for that in-depth review of our financial results. Before we open up the lines for questions, CEO, can you please take us through the forward-looking statements for the business? Share with us what you have planned going into the future for a post-COVID AXA. Thank you, CEO.
Thank you very much, Referencer. As far back as March, when we realized the devastating impact of COVID, we've been engaged in extensive exercises of consultation with our stakeholders, but also re-strategizing and repositioning the business. We confirm our vision as one where we continue to be the most sought-after partner in the world for the provisioning of sustainable airport management solutions by 2030. We have, however, in recognizing the devastating impact of COVID, are quite clear that we need to move our strategy pillars forward in order to be able to deal initially with a recovery period which starts in timeframe 1, as indicated in that slide. And now our programs are cut within 5-year timeframes, which will help us in implementing our strategy moving forward. In timeframe 1, which is between now and 2025, in the recovery stage, our focus will be on defending the core business, continuing to operate the airports, transforming the company and increasing revenue, which would contribute towards economic growth. But we are starting to plant the seeds of moving the company in a new direction. As the CFO indicated, our focus in these next 5 years would be minimum capital expenditure. Basically, we'll be focusing on replacement and refurbish infrastructure only in a very, very fiscally constrained environment. Our time frame 2, from 2026 to 2030, we start seeing the shoots of emerging businesses to drive revenue growth and contributing towards economic growth to ensure the company's long-term future. In this period, we'll see more investment partnerships, and we'll be focused on investments that increase our capacity to deal with the responding growth in traffic and in revenue. In timeframe 3, which is beyond 2020, would want to operate a new AXA in a redirected focus and growth trajectory with pronounced growth. So effectively, we have staggered the main pillars of our strategy into those 3 timeframes, recognizing that in the first time frame, we have to really deal with the recovery mode and get the company operating normally. So our strategy really has the 3 pillars I've highlighted: run airports and run them efficiently, optimally, and innovatively. And the focus areas there, as the CFO has indicated, would be the aggressive cost-cutting, cost reduction program and reviewed capital investment program, as we've already indicated, and the issue related to air traffic recovery program. We also would be focusing on increasing our reputation through demonstrated business excellence and to build our brand and reputation and rebuild confidence in air travel. The second pillar, which is developing airports, which is likely to really take effect in the next period of 5 years, from 2026 onwards, is to transform the AXA business, continue with the transformation program, reduce environmental impact, and importantly, ensure we retain our standards with respect to the ACI carbon accreditation. Only in the period thereafter, we would see growing our footprint. We've provided a slide on slide 33, which gives you a very clear indication of our global footprint, the activities that we have in various countries in the world, the partnerships that we have in India, Brazil, and other countries on the continent of Africa. And that slide illustrates our return to global footprint. Growing our global footprint is going to be quite important in the period 2030 onwards. What we do see there is an opportunity for us to really improve prospects for diversifying our business portfolio through revenue enhancement. We are looking at the cargo sector, which has shown promising growth across our economy as a result of COVID. But importantly, we believe that in the South African economy, we've not been focusing on cargo and export particularly, and this will become a new focus. Aerotropolis development in the Golden Triangle of OR Tambo, King Shaka, and Cape Town International Airport become very important initiatives that we will pursue for implementation in that period. But truly, we believe the planning for the Aerotropolis development starts now and will only be guided by our revenue generation, the extent to which we can make investments after the recovery period. Our business priorities continue to be our people and culture, our governance areas with the revised governance framework and operating model. We would be looking at operational efficiency, even to the extent of looking at methods for insourcing and outsourcing parts of our business, and importantly, allowing ourselves to be driven by digitization and innovation, including the artificial intelligence thermographic solutions. So our sustainability framework is going to be driven by our environment, striving to be carbon neutral, our people, contributing more to Black economic empowerment and airport connectivity, and diversifying our workforce, and then our business, enhancing our reputation, improving the passenger experience, and increasing shareholder value. We would contribute to air traffic growth and diversification of our business. Looking forward, therefore, we really aim to focus on implementing our revised strategy, as I indicated, and our emphasis would be on technology-driven innovations to enhance the passenger experience, the cargo strategy, a very important growth point for aeronautical revenue generation, impactful partnerships, planning for the implementation of Aerotropolis strategy, implementing our recovery and sustain tactical plan for financial sustainability that has been highlighted in the financial plan, our revised operating model and capital and capability model, our revised and refined organizational structure and governance framework. We really aim to also quite aggressively look at integrated marketing and communication as a new way of bringing back air traffic into our markets, and importantly promoting air travel. And then also looking at unconventional markets that we've previously not looked at in order to diversify our revenue streams. Importantly, our airports, and this is what is done in airports across the world, need to be developed to being airport precincts as a destination in their own right, which will see us diversifying the service offering, the commercial activities, and the business offering inside our airport precincts, but also more importantly, being more accessible to our neighboring communities for their benefit into the future. Thank you.
Thank you very much for that concluding presentation, CEO. Ladies and gentlemen, I now have a number of questions which have come through. And the first question goes to you, CFO. It comes from Tamaga Lisito, and Tamaga wants to know, what was the average increase in employee costs? That's the first one. And the second question, I think this one is for you, CEO, in terms of just the business of aviation since Level 1 international travel has been introduced. How has the traffic been? And have we seen an increase in activity around airports? We'll start with you, CFO. Thank you.
Thank you very much for the question. Overall, the employee costs went up by about 11%. Of that, obviously, one of the contributing factors was the actual headcount increase. So we increased by about 80. On the pure salary increase is about 6% overall. However, there was also, as I mentioned earlier, the impact of full year of staff transport that affected our numbers this year. So there's three areas: the actual headcount reduction, the salary increase, and also the staff transport, giving us an overall increase of about 11%. Thank you.
Thank you. Then moving on to the next set of questions, and yes, CEO, you can come in.
Thank you. Sorry. Just with respect to the question about air traffic, importantly, in this period, we've been observing both the growth in departing movements and departing passengers. And I must indicate that at lockdown in March, for the months of March and or the months of April and May, we saw a devastating impact on our airports with a total shutdown with the exception of repatriation flights. We started seeing some improvements in June with 473 departing movements across our airports, and that has increased to 3,190 air traffic movements now in October, and we would see even further already 2,967 air traffic movements. What we're expecting in the departing passengers from June, the numbers have increased initially with the repatriation flights and the initial level 3 opening up to 39,586 to where we are in October now. Our September figures were 341,000, and in October up to the 20th, we're at 291,000. What has also improved over this period between June and now, with the levels increasing from level 3 to level 1, is the departing load factor, which has improved from June from 61.45%. We are now in September had a load factor of 84.81%, and importantly in October at 79.6%. So overall, we've seen a dramatic increase. We're still not anywhere near our 2019 performance levels, both in terms of passenger and air traffic movements. But importantly, what we are seeing is with the load factors increase is a promise that the situation can only get better. Thank you.
Thank you, CEO. I think that's a bit of comforting news, even though the road ahead is still a very long one. The next question is for you, CFO. Which additional credit facilities are you still pursuing, and for what purpose?
Okay, thank you very much. In terms of the additional credit facilities, we've got at least in the next 3 years, a funding requirement of about 3.5 billion to fund primarily, obviously, not just our operating costs, but also the capital expenditure. So we are looking at additional facilities. Currently, we are close to finalizing some of the facilities with the Development Bank of South Africa, and also we are also talking to other financial institutions as well. But primarily, the funding is to fund our not only our operating but capital expenditure as well.
The next one still for you, CFO. What exactly does it mean that the business will be looking to monetize the property portfolio?
Thank you very much for the question. As I've said earlier, we've got an investment property portfolio of 7.7 billion, which has appreciated with the revaluation that we did. The primary reason we want to monetize the portfolio is that what we see going forward from a traffic volume forecast is that the recovery will take much longer. And as the recovery take much longer, we will be under some serious liquidity challenge. And we believe that monetizing this investment portfolio will help us. The modalities of how we are going to monetize it could be an outright sale, or we could go the concession route so that we can improve the liquidity thereof. So we are looking at boosting our liquidity through that investment portfolio by at least about 3 billion rand, as I've indicated earlier. It's primarily to improve our liquidity.
Okay. And I think not directly related, but within the same space, is what was the reason for recognizing a gain on the investment properties?
Thank you. As indicated earlier, we use the income capitalization approach. The significant movement for the year was that there were a couple of new leases that were signed, and also the renewal of existing leases, which then effectively improve the valuation of the property. So our assets are well positioned physically in terms of they are very attractive, and they are generating very good yields. And going forward, we believe that value is fair, and that's the primary driver. New leases signed, and also some renewals will actually just helped improve the value.
Thank you very much. The next question is yours, CEO. What does the travel restrictions, particularly for high-risk countries, mean for AXA moving forward? Do you have any indications for when some of these restrictions will be eased?
Thank you very much for the question. Importantly, what government has indicated in imposing the latest travel restrictions is that they will be reviewing their list of countries where they basically restrict travelers of a particular category. Let me indicate that the current restriction that's in place suggests that people who are traveling for business purposes, for academic, for sports, for other business-related issues are allowed to travel to South Africa, even from those countries. The restriction only applies to travelers for leisure. What it means for AXA is that we continue to see a very dampened projection towards the growth of our passenger figures, importantly because the bulk of them do tend to come from the leisure travelers. But we're quite confident that we're doing enough work to start seeing travelers who are not on that list, from countries that are not on that list, starting to travel into South Africa. And importantly, as the list is reviewed every 2 weeks, we are engaging, we are also participating in the process that allows for the re-evaluation of those countries in order to be able to increase. So we hope to see a growth in leisure travel, which impacts very positively on our revenue in the airport. But importantly, we will see that as those restrictions are lessened. What we also anticipate is that government will take off certain countries off that list as they continue to review the situation. The real challenge is also about preparing the tourism industry to be able to receive the leisure travelers in a safe way that is regulated, that also allows them to enjoy travel for the long haul. We're hoping as AXA that when we find the solution towards how we best manage leisure travelers and define them as a lower risk, importantly, that will mean they will also be allowed to fly. And that will be good news for us, because the countries that provide the biggest numbers of tourists' contribution to our country are very important to us and our business. Thank you.
As a follow-up, CEO, one of the indications that has been given is passenger confidence in terms of passengers returning to using air travel. What measures has AXA put in place to make sure that passengers are confident or are reassured in their safety when traveling?
We work in a highly regulated environment, and importantly, we are also regulated specifically for COVID. So in implementing the regulations that are issued by the Civil Aviation Authority and government in the various regulatory instruments who are provided, we have implemented fully the programs of sanitize. We started with deep cleaning all of our airports and promoting sanitization, social distancing. We've really changed our business in our terminal buildings to be as touchless as possible. We've reduced the touch points. We've introduced screening at counters. We encourage passengers to self-check-in at the boarding gates. They are basically self-boarding. In the security center point, they are not being touched by our staff, and importantly, they are able to process themselves throughout the airport terminal building. That's a very important measure we've put in place overall to provide safety, health, restricted traveling, which actually enables our passengers to be confident that they are unlikely to contract COVID whilst traveling through our airports. We have employed social distancing and airport monitors who are there to guide people and enforce those regulations throughout the airports. That's the first part which we do as part of the COVID response measures. But importantly, we also are approaching various communities in order to promote these measures that we have taken and provide confidence in passengers that we actually do provide a safe passenger journey through our airports, and show them the measures we have taken throughout in order for them to feel quite comfortable about booking an airline ticket and traveling without fearing that they would be able to contract. The other issue we've done is to restrict the numbers of people coming into our airports. Currently, we do not even allow meeters and greeters, simply to be able to implement the social distancing measures that are inside the airport building. We've restricted cars entering a particular area on our airports and just diverted traffic in order to minimize the number of people in order to enforce social distancing for a healthy passage for our travelers on their journeys.
Thank you. The next question goes to you, CFO. Have you had any update on the support requested from National Treasury? Is there a likelihood of it being granted?
Okay. Thank you very much for the question. At this stage, other than the negotiations and interactions with the National Treasury, we haven't formally received any response to it, even though we are confident that it could be granted, but at this point we don't have feedback on that particular issue. Our request is primarily for a guarantee, not necessarily an outright equity injection. So the request is with Treasury, and we are waiting a response on that.
So CFO, what would that guarantee mean for AXA's position?
What it means, it just strengthens our credit profile in that from the lender's perspective, they can have confidence that we've got somebody behind us. Even though obviously that all comes in the context of where we find ourselves as AXA in the aviation industry. There is a lot of uncertainty at the moment in terms of the return of the demand, and the guarantee will just be an extra comfort to the lenders that there's somebody behind us for it. So we have requested a government guarantee, but there is no outcome at this point in time.
Okay, still with you, CFO. What level of debt is optimal for AXA given the strategy of de-gearing that AXA has been following?
Thank you very much. In terms of what is optimal, our appetite overall is not to exceed 65% gearing. As I've said earlier, even with COVID, if you look at our debt projections, we are unlikely to hit a 65% limit. In fact, on our worst case scenario, as I've said earlier, we're looking at a gearing of 53% in about 4 years' time. But our limit is at, our appetite is at 65%. And if you look at the 5 to 6 year period, we are looking at our debt going up to about 11 billion.
Still with you, CFO, what impairment losses have been accounted for in the company for the investment in Groupa? In 2019, the carrying value was 1.15 billion.
The GRU investment is now, thank you, is now almost fully impaired. So we don't have a GRU investment in our books. What we have is MEAL investment at them. So we have actually impaired it.
Okay. And another one for you, CFO. Does AXA have the ability to further reduce operating expenses? What is the average contract term with the service providers like cleaning companies, security, etc., meaning like the outsourced services?
Thank you very much for the question. Yes, we believe that we have done a lot to reduce our operating cost by 25%, which is quite significant. There's always room for further cost reduction, especially if the traffic demand is, the return of the traffic demand is low. So we've cut 25%. Obviously, we'll continue to pursue for more where possible. In terms of the contractual arrangements, our contracts on average run up to maximum about 5 years, and it differs for each and every security contracts. Might still have a few years to go. The clinical, so it varies in terms of what is the period. But what we have done in the meantime to optimize cost and also just to improve cash flow, we've been renegotiating terms with each and every supplier in terms of reducing the requirements where necessary, for instance, even on security, even on cleaning, so that we can improve liquidity and also improve our cost. So even though there could be a contract in place, what we are doing is just to, where possible, renegotiate whether we can reduce the requirement where possible, and so that we can also improve our situation.
The CEO did indicate in her presentation that one of the strategies being considered going forward is which areas of the business to insource or outsource. Would that, the primary driver of that, be to further reduce operating expenses?
Primarily.
Okay, thank you for that. The next is a comment and not a question from Vis Logan, our dear stakeholder from the Airlines Association of Southern Africa. He says, thank you for an excellent presentation, very simple and easy to understand.
Thank you.
Then the next question, your CFO, what are the forward-looking financial scenarios given the current low levels of traffic volumes? Can you please provide an update?
Look, I think when we communicated around May, June, in terms of our forecast, we were anticipating at least a 50% decline in traffic volume for 2020-21. With a delay in the opening of borders and all the restrictions which we've spoken about just now, we are anticipating at least a 60% decline for this financial year on the traffic volumes, and obviously a gradual improvement in the coming years. So in terms of the projection, obviously we are only 6 months into the financial year. We will continue to update the projections, but overall we are looking at least a 60% decline in traffic volume, and that will be reflected in our numbers for 2020-21.
Okay. Then the next question is, can you please provide some detail on the current operating expenses run rate versus pre-COVID levels?
Thank you very much. What is positive for us, as previously communicated, is that we've agreed on this significant cost cuts, and we are on track in terms of the discipline around the execution of that. Just to reflect, we had cut our cost for this year, operating cost, by 900 million rand, and we are on track to achieve that target of cost savings. So we are anticipating to finish the year with an expenditure of about 3.9 billion for the year, from the budget of about 4.7 billion before.
Okay. As CEO, this one is for you. If focus is on technology-driven innovation to enable digitization, while forecasts for the next 3 years show air traffic to drop up to 60% and only 50% of people willing to fly short-term, surely with staff costs as the largest op cost, please explain why retrenchments are not being considered.
We have considered several options to achieve the operational expenditure reductions, and amongst those are staff cost reductions. And in the category of staff cost reductions, we really are exploring several ways in which we can achieve that. We are looking at measures including early retirements. We are looking at measures as impactful as voluntary severance packages, but we're also looking at measures that include job sharing. The reconfiguration of our business with the low traffic volumes allows us an opportunity to truly evaluate what our staff does in the operational environment and be able to share. We have considered that if we do not achieve the targets we've set for ourselves with respect to the staff cost reductions we have projected, as a measure of last resort, we may get to issues of retrenchments. But according to our plans right now, there is enough that we can do to cut our staff costs with these other measures I have outlined before we get to retrenchments. We're part of the South African economy. We're part of the country, and really we would not want to be contributing towards massive job losses unnecessarily if we can still find measures within the company to help us to reduce the cost of staff. And we will explore those quite aggressively and achieve the targets we've set for ourselves.
Thank you, CEO. Back to you, CFO. Can you give us an update on the sale of investments in Brazil and India?
Okay, thank you very much for the question. We are currently in the process of negotiating some of the terms attached to those 2 investments. So some of the details are, it's not something that we can share, but what we can confirm that we've got firm offers on the table, and one of, especially the Indian disposal, we hope to hopefully close it before the end of this calendar year, which is December 2020, and the Brazil investment could take a bit of time in terms of the negotiation.
Okay. And then the Next one still for you, CFO. Given the COVID impact, can you please share the latest AXA liquidity position or liquidity requirements versus available committed facilities?
Okay. Thank you very much. What is positive, which didn't come up through in the presentation, is that when we closed the financial year, we had cash and cash equivalents of about 1.7 billion. And during the first 6 months, even though there was not much trading, we did collect some cash from customers. And I'm proud to say that by the time we finished the first 6 months of the financial year, we never had to borrow. We were still using our cash as a company. For 6 months, in a difficult COVID environment, we were still utilizing our cash. As you quite correctly say, we've secured 3 billion rand in facilities, and that should be sufficient to cover us for this financial year, for both our operational requirements and also from CapEx requirements. So we are anticipating to utilize perhaps 2 billion rand of that facility in that in this financial year.
Okay, and then the next one is, what is the average tariff applicable for financial year 21?
It's 3.3%.
Okay,
A tariff increase.
tariff increases.
Yes, yeah.
Okay. Have you revised the pricing strategy for the leases at the airports for the non-aeronautical side of the business? And what is the expected impact considering low levels of activity?
Okay, thank you very much once again. What we realized soon enough going into COVID is that everyone is under pressure. The airports were closed for extended period. So initially we did pass some credit notes for most. And what we've done, we also moved as far as possible to a turnover-based rental instead of a fixed plus turnover-based rental. So we hope that through those measures we can cushion and hopefully at the end we can all survive. So we have measures that we've introduced to support the retailers, obviously the concessionaires at our airports during this period.
The next one, and this is our second last question, can you provide an update on the performance of the Brazil and India concessions? Are they generating any cash? Is there any value in these businesses given current activity levels which could be extracted through sale?
Okay. First part of the question, thank you very much. Whether they are making profit at this point in time, clearly with COVID, all airports are under pressure, making losses. I think earlier in the presentation from the CEO, you could see that airports across the globe would lose money in this financial year. So in terms of, is there still rationale in this? As I've indicated, we are in a process of disposal of these investments. What I can show you, if I look at what we are possibly going to get in return, it's going to be on a net basis probably higher than what we invested on these investments, just looking at them collectively. So we are in the process of disposing. The first one, the India, is closed before December, and the GRU is what we are still in the process of negotiation.
Okay, thank you. And the last question is, earlier this year, AXA indicated that OPEX will be managed by cutting costs, by reducing employee costs. No increases of bonus, no overtime, and consider early retirement packages. For the year ahead, is this still the plan? And if so, by what percentage or rent value do you expect this to drop OPEX by?
Thank you. Once again, yes, we're still on track with the program. And in terms of our targeted savings, and we are looking at about 300 million rand savings.
Okay, thank you for that. Then there's another question that just came in. There were media reports that our partner in India wants to buy our stake in Mumbai Airport. Have we approved this? If yes, what is the financial value we can get from this, and would it alleviate the further cost reductions and mitigate debt?
Thank you. As indicated earlier, yes, there is an offer on the table. The details of the quantum and all of that we cannot disclose at this point in time, but it does look good. If it does come through, definitely it does help us with our liquidity challenges, at least in the short to medium term.
Okay.
Yeah, thank you very
Thank
much.
you. That was our last question. CEO, in closing, what message do you want to share with our guests this morning?
Thank you very much for the opportunity, Refense. Thank you very much for the guests who joined us for this particular session. We hope we have been able to share with you very important information that influences our business, from the international trends to our current financial situation and the impact our economy has had on our business. Importantly, AXA is a company that has shown much resilience through the COVID pandemic. We have faced possibly unprecedented levels of financial loss in particularly the 2 months where there was no revenue from domestic and international traffic. However, we are on a path to a very exciting future. We truly believe the strategy we've put together is one that changes the way we've previously done business, forces us to diversify our revenues and look at the business offering, continue to run airports efficiently, develop and grow our footprint. And importantly, in that aspect, we hope to work with the stakeholders who are our audience today to achieve these very ambitious objectives we have set for ourselves in the recovery plan as we move forward. It's going to be difficult for us as a company, as it is going to be for the country in the initial years as we recover, but we really see bright shoots showing us a diversified company that emerges when business returns in about 3 or 5 years, which promises to be very different from the airports company you've known today, with more ambitious program, with growth opportunities, and also just changing the way our airport precincts are used today in order to generate much needed revenues. Thank you very much for joining us, and we hope we'll be able to follow through with further questions and in the afternoon with further media houses. But more importantly, at this time, we'd like to thank our staff who have contributed immensely to the stability that has been shown in the company in this very difficult period. It is our people that give us the confidence to be able to survive the COVID pandemic, but also emerge stronger with a much better company into the future that promises to remain central globally and in our country. Thank you.
There you have it, ladies and gentlemen, from the lips of the CEO. Recovery will be painful. However, there's a very bright future for AXA to look forward to. That is all we have time for today. Thank you to our executive directors in studio with us today. And thank you to our viewers for joining us from across the country. Stay safe and God bless.